Hello, this is a recording on the module MBA4807. In this recording, I am going to be taking you through the management accounting section of the October-November 2019 paper. As previously stated in the other videos, I'm going through the exam prep, focusing on different areas of the paper. So I think I've gone through the financial accounting sections sufficiently enough. So maybe in about 2 or 3 recordings, I'm going to take you through some important things with regards to the management accounting section. And then coupled with your own exam revision, I think you'll be ready for the exam. So in the October-November 2019 paper, question 1 in the management accounting section gave you a scenario. It had 20 marks. The question said your policy is to invest in assets with a maximum payback of 3 years. The company also makes provision to use the net present value as another method to select projects. Only investments with a positive NPV will be selected. So there are some capital budgeting techniques that we can use to decide whether or not to invest in a project. The most common one is the net present value, and this one came up in the assignment. Please make sure you are also comfortable with the payback. I'm sure in your prescribed textbook, they do talk about that technique, or you can try to look at the solutions that I gave you, the memos for the other papers, but please make sure you're familiar with the payback technique. The payback technique is simply determining how long it takes for a project to pay back the initial investment. For example, if you spend 1 million as an initial investment, and then you get 200,000 in the first year, 200,000 in the second year, 200,000 in the third year, 200 in the fourth year, and 200 in the fifth year, it means your payback is 5 years. It took 5 years for the initial investment of 1 million to be paid back. So please, it's worth you understanding the payback. It's a really important capital budgeting technique. So management has decided to invest in a new machine to increase the current production output. The production manager has identified a machine, and you have been tasked to evaluate the investment in the machine to determine if the company's investment policy will be complied with. Okay, so you're trying to make a capital budgeting decision. The production manager gave you the following information. The cost of the machine is 650,000. The installation cost is 80,000. The useful life is 4 years. And then we were given the incremental profit before depreciation and tax for each year, otherwise known as the operating profit. Actually, no, we won't say the operating profit. We'll just leave it as it is, incremental profit before depreciation and tax. And then we're given the incremental profit for each year. The cost of capital is 10%. Depreciation on plant and equipment is based on the straight line method over the useful life of the asset. This method is allowed for tax purposes, and the tax rate is 30%. So you're asked to firstly calculate the annual cash flow. Secondly, calculate the net present value and advise the management accordingly. Now, you need to be comfortable with this template to calculate the incremental cash flow. Sometimes the annual cash flow, sometimes they say ignore tax. You don't have to worry about tax. I'll explain how you would approach the question if you're told to ignore tax. But if there's tax, this is the template. You start with your incremental profit before depreciation and tax, these amounts right here. And then you subtract depreciation. So we were told that our depreciation is on a straight line basis over the useful life of the asset. Okay, so what that means is that we take 650,000 and we divide it by 4. We take 650,000 divided by 4, and then that gives us the depreciation per year. So if you say 650,000 divided by 4, we get 162,500. So that's where the depreciation expense came from. It came from taking the cost price of the asset divided by the number of useful years of life of the asset. If we had been given a salvage value, we would say cost of the asset minus salvage value divided by the number of years of life to give us depreciation. So we would first subtract the salvage value before dividing by the number of years of life to give us the annual depreciation. So we take our incremental profit before tax and depreciation, then we subtract the depreciation expense, and then when we subtract the depreciation expense, we get the incremental profit before tax, right? And then we subtract tax at 30%, so it's 30% of 1750, 30% of 3250, 30% of the profit. So we subtract these tax expenses, and then we get the incremental profit, which are these amounts, and then we add back depreciation. So we just subtracted depreciation here so that we could accurately calculate the tax expense. But once we get our incremental profit, also known as the net operating profit after tax, we then add back depreciation. And then the final answer we get is the annual cash flow. So if we had been told to ignore tax, it means that we were simply going to take our incremental profit before tax and depreciation as it is. We were just going to use this amount. We were not going to worry about tax. We went through this whole procedure to see the effects of tax. Okay, so if there was the question didn't say anything about tax, we would just work with these amounts, this 180, 195, 210, 235. The only reason we subtracted tax and then we subtracted depreciation and then we added back and we removed tax is that we wanted to get the accurate tax expense. So this is a very important calculation right here, right? And then the next part of the question asks you to determine the net present value and to advise management accordingly. You are asked to get the net present value and to advise management accordingly. So to calculate the net present value, you can use your financial calculator. I do have a financial calculator and I'll put it up on the screen. Remember, these cash flows are what's going to be coming into the company as a result of the machine. So they're going to be CF1, CF2, CF3, and CF4 respectively. Please note for the last year for CF4, always check to see if there is no salvage value on the sale of the existing asset. Sometimes the existing asset is sold at the end of its life and then you have a salvage value. So you would need to add that final cash flow to year 4. But in this case, there's no salvage value. So we just take these cash flows as they are. And then here we have 730. We got the 730 by taking the cost of the new machine plus installation. So it's 650 plus 80. That gives us 730. So it's a negative because it's money going out. And please note here for CF0, when you're calculating the initial investment, be sure to check if there is no increase in working capital. If there was also an increase in working capital, we would add that. It means, let's say we had an increase in working capital of 20,000. Our initial investment would be 730 plus 20,000, making it 750. So always check for installation costs, always check for change in net working capital, even delivery expenses are also added. The only expenses that you don't add to the initial investment are expenses for things like research and development, things like consultation fees. Those are known as sunk costs. Okay, research and development, marketing, consultation fees, they happen before the project. But the cost of the machine, delivery expenses, installation expenses, changing in net working capital are all added. And you're always also given a discount rate. So let's use the HP financial calculator to calculate our NPV. So you clear your calculator first, you press this button, then see, make sure it's on 1 PYR. If it's not, you need to adjust your calculator. By default, your calculator will be on 12 PYR if you buy it and it's a new calculator. So to remove this, you press 1, the red shift button, then PYR, and then now my calculator is fine. So I say 730, 730, okay, as a negative, 174,750, 185,250, 195,750, 213,250. Interest rate is 10%. Red shift button, and then sorry, before the red shift button, you put your interest. Sorry, need to start this again. We said 730 as the negative, 174,750, 185,250, 195,750, 213,250. 10% is our interest, red shift button, and then we get minus 125,1470. So because it's negative, management should not purchase the new machine because the NPV is negative. Remember, we accept a project if the NPV is positive, but if the NPV is negative, we reject a project. So that's very important. Please note, let's say you had been asked to calculate the payback, just a word of advice. Let's say you had been asked to calculate the payback. What you would do to determine when the initial investment of the company is actually recouped, you would say 174,750, right? Plus 185,250, and then you would get 360,000. So by the end of year 2, we've recovered 360,000, which means we still haven't recovered the 730. Then in year 3, you so to 360, you then add 195,750. So it means in year 3, we've now recovered 557,750, right? And then we add 213,250. So in year 4, we've covered 769,000. So it means between these two, between 3 and 4, that's when we are getting to 730. Because here we are at 55750 if we add all these cash flows, 174, 185, 195. And here we are at 769 if we add all these cash flows. So it means the 730 is being recovered somewhere in between. So to get the actual payback, you then, since it's somewhere between 3 and 4, you say 3 plus, right, over, and then you put this cash flow, the next cash flow in between when you are recovering your cash flows, over 213,250, right? And then on top, you say 730 minus the total of these first 3 cash flows. So it will be 730 minus 557, 750, giving us 172, giving us 172, 250, right? And then you say 172, 250. Okay. So now to get your payback, you then say 3 plus 172, 250 over 213, 250. Over 213, 250. So you say 3, 172, 250 over 213, over 213, 250, which gives you 3.8 years. So it means it takes 3.8 years to recover the initial investment. So try to see between which 2 years your money is being recovered. Take the first year between those two, plus underneath put this cash flow that comes afterwards, after the first year you took, and then take your initial investment minus all the total cash flows corresponding to the year, the first year between which the two cash flows are recovered. So the payback is just something worth knowing also for the exam. Next, let's look at question 2. Question 2 was worth 10 marks, and the question said, Arcadia company manufactures recreational vehicles and incurred the following costs during the current year. So this question was just a matter of separating costs between product costs and period costs. And so it's important for you to be able to distinguish between different expenses. I'll just take you through this quickly. Things like wages of general office personnel, these don't have to do with the manufacture of any product. They don't have to deal directly with manufacturing any product. And those type of expenses are known as period costs. And in particular, this one is an administrative expense because we're dealing with administrative personnel. Cost of tires, this company manufactures vehicles. So cost of tires, this is material directly involved in manufacturing the vehicles, it's direct materials, and it falls under a product cost because it's related directly to the production of a particular item. Factory supervisor salary, this is an overhead cost. It is related directly to the production, it's related to the production of goods, but not directly, because a factory supervisor oversees the manufacture of all goods. So it can't, the expense can't be traced directly to a particular vehicle. Conference for marketing personnel, period cost, underselling expense. It's not associated with producing anything. Factory security guards, this is an overhead. It is associated with producing, but it can't be tied directly to a particular unit because factory security guards guard the whole factory. They don't guard any particular unit. Research and development, this is an admin expense. It's not tied to actually producing any goods. Assembly line workers, this is direct labor. An assembly line worker will work on the production of a particular vehicle or particular product associated with the vehicle. So it's a product cost and it's directly, you can see what input the labor is putting in the production of the good. Company receptionist, this is an admin expense. Advertising cost, this is a selling expense. Cost of shipping vehicles to customers, this is also a selling expense. Okay. Then question number 3. Question number 3 involves cost volume profit analysis, which is very, very important for the exam. It's been coming a lot in past papers. You need to understand things like break-even points, margin of safety ratios. So it's important for you to go through the assignment. There were a lot of important questions in the assignment touching on this. So we're given a company year and we're provided some information associated with the company's income statement. Make sure you're comfortable with this format of the income statement. In this module, they tend to put variable costs, for example, year, then they put the total year. Remember, 240, which is sales less variable cost, gives us the contribution margin, also known as the gross profit. The gross profit or contribution margin less the fixed costs The total fixed costs are 120. The contribution margin less the total fixed cost gives us the operating income. So here you don't have to worry about tax. So for 6 marks, you are asked to determine the break-even point in units and rent value. The break-even point in units is given by total fixed costs over selling price per unit minus variable cost per unit. The selling price per unit is given by total sales over number of units. So our total sales were 240,000 divided by 12,000 units, giving us a selling price per unit of 20 Rand. The variable cost per unit is total variable cost divided by number of units. That's 96,000. Those are the total variable cost divided by 12,000, giving us 8 Rand per unit. So the break-even point in units is 120,000 over 20 minus 8, giving us 10,000 units. So it means the company will be making zero profit. They start making profit as soon as they go above 10,000 units. If they're 10,000 units, they're not making any profit. Above 10,000 units, they are now making a profit. Below 10,000 units, they are making a loss. And then the break-even point in rands is simply the break-even point in units times the selling price per unit, giving us 200,000 Rand. The next part of the question said that the sales manager believed the company could increase sales by 1,000 units if advertising expenditures were increased by 15,000 Rand. By how much will operating expense increase or decrease if the advertising is increased as suggested? So this is the cost volume profit analysis we're talking about. We change volume, we change costs, and we try to see how that affects profit, cost volume profit analysis. So here we're told that sales increased by 1,000 units and advertising increased by 15,000 units. So here you need to be really careful to try to follow the changes that are taking place. I'll try to take you through the changes as best as I can. So firstly, we can get the change in sales. So our new sales are going to be the new number of units, which is 13,000. They've gone up by 1,000, so it's 12,000 plus 1,000, which is 13,000, times the selling price per unit, which is 20 Rand, giving us new sales of 260,000. So the increase in sales is going to be the new sales of 260,000 minus the existing sales of 240,000, giving us increase in sales of 20,000. So this is a positive. If sales goes up, if sales go up, this is a positive. So this increase in sales, we would put a plus there because it's something positive. Now let's look at the change in variable costs. So this would be 20,000 adding to profit. Now the change in variable costs, we can get the new variable costs. Remember, if you increase units, you also increase variable costs. So we take the new number of units times the variable cost and we get 104,000. And then we can get the increase in variable costs. But an increase in a cost is something bad. So we could put a negative there if we're looking at the effect of the change in variable costs on our profit. So now we can see the total effect on our profit, right? So the total effect on the contribution margin, which increases and which affects our profit, would be the positive due to an increase in sales, the positive due to an increase in sales, minus the negative due to an increase in variable costs. Therefore, our contribution margin will increase by 12,000. Okay, so it means our profit, the contribution margin will increase operating income by 12,000. But remember, even though our contribution margin is going up by 12,000, increasing profit by 12,000, we've been told that the change in 1,000 units is coming about because of advertising. So we then subtract the expense associated with advertising, because that's an expense if you increase advertising, meaning that the net effect will be a reduction in our operating income of minus 3,000. Then lastly, what is the maximum amount the company could pay for advertising if advertising could increase sales by 1,000 units? Okay, So what's the maximum the company could pay for advertising if advertising could increase sales by 1? So, so with this advertising, since the profit would go down by 3,000 Rand for an increase in sales of 1,000 units when advertising is increased by 15,000 units, right? So it means when advertising is increased by 15,000 Rand. So it means advertising of 15,000 Rand, right, is actually leading to a decrease in profit of 3,000 Rand. So we would need that advertising to go down to 12,000 Rand, so that 3,000 of the cost associated with advertising from that 15,000, 3,000 of that cost would then go over to our profit. Okay, so therefore we would need advertising to only increase by 12,000. We would need to reduce advertising by 3,000 to help us cover that loss. So the maximum advertising can increase to is 12,000 to break even. Therefore, the most and maximum amount the company could pay for advertising is 12,000. Okay, so those are important questions and they come up a lot: cost, volume, profit analysis. And then lastly, question 4, explain the term management by objectives. So this was just a theory question they threw in there, and I just wrote a brief description about what we mean. It's overlapping with strategic management. Sometimes in these modules, MBA modules, some of the content you are asked, yes, does overlap. So this is a strategic management model that aims to improve the performance of an organization by clearly defining objectives that are agreed to by both management and employees. According to the theory, having a say in goal setting and action plans encourages participation and commitment among employees, as well as aligning objectives across the organization. Okay. This paper was relatively okay if you prepared properly, and I hope this recording was helpful. Make sure to couple your revision of past papers with assignments as well. Assignments always have some important aspects to them. Okay, so that brings me to an end of this session. I hope the recording has been helpful. If you have any questions or queries with regards to the concepts I covered in this recording, please feel free to let me know. I won't always be able to get back to you, but I'll try to get back to you as promptly as I can. Thank you.